All right. So, good evening, everybody. Good evening. Welcome to the Wealth Mindset and Real Estate Investing virtual meetup. I really appreciate you being here. Tonight, I am your host of the Wealth Mindset and Real Estate Investing virtual meetup. I'm also a managing partner at Boost Capital Group and the CEO and co-founder of Red Fox Multifamily. Before we go ahead and get started with everything, I wanted to take a brief moment to be able to introduce our sponsors. So first of all, tell you a little bit about wealth mindset and real estate investing. So wealth mindset and real estate investing meetup is open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in this group make a good living and have discretionary income to invest real estate for its proven wealth building power, but don't have the time, skill set, or network to do so at speed and scale. This meetup focuses on helping us all grow our wealth mindset by learning how to build and preserve wealth while continuing to build it and maintain our abundance mindset. The meetup will focus on multifamily real estate investing as well as other proven ways to build wealth through real estate through passive investments. And to go on, we're sponsored by Red Fox Multifamily. Red Fox Multifamily helps pharmaceutical and life science industry professionals diversify their portfolios and earn passive income and get all the other perks of real estate investing without having to do any of the work themselves. Red Fox Multifamily partners with passive investors to buy commercial multifamily real estate based on vetted opportunities we get access to from our trusted network of top operators in the best markets throughout the country. Partnering with Red Fox Multifamily makes investing in real estate completely hands off, allowing investors to add passive income and build equity, all while being in an investment vehicle that is backed by a hard asset. So thank you very much for that brief moment. And our last sponsor, is Boost Capital Group. Boost Capital Group's vision is to become the premier partner for busy professionals and entrepreneurs seeking to build and preserve their wealth through passive real estate investments. So let's connect it. For those of you who this is your first time joining, I love connecting with people. If you want to learn a little bit more about me or what we do at Red Fox Multifamily and at Boots Capital, please do reach out. My email is on the screen. You could also go ahead and scan the QR code, and that will also give you access to my contact information. So our agenda for this evening, we're going to introduce our speaker for the evening, and then the speaker is going to give a presentation and give you a little bit of the logistics in terms of how he wants to run things. So listen up for that. Then we'll have a little time for Q&A for our guest speaker tonight, as well as an opportunity for some virtual networking if time permits. So some other logistics, please mute your lines when you're not speaking to reduce the background noise. Hold questions to the end of the presentation unless the speaker invites you to speak up. The presentation is being recorded, and this material does not constitute an offer or a solicitation to purchase securities. This is for information purposes only and should not be construed as business, financial, or legal advice. So let me get a little bit into our speaker this evening. So I got to tell you a little personal story before I read the bio. So John and I, we've kind of come up in some of the same real estate investment and fund management groups. And, I got a chance to learn about John and what he's been doing and the success that he's been having in this space. And, not only from his professional background, which I'll read from in a moment, but from his entrepreneurial background as well as a seasoned real estate investor. And what I like to do from a meetup perspective is, make sure that I can bring experts and like John into this space to be able to share his insights and perspectives with folks like all of you that join us for our presentation, that watch us on our YouTube channel, tune in for our email content and everything in between. So John, you're gonna be treated tonight where John is gonna talk about the multifamily market cycle and why now is the time to buy and invest. But let me get into John, a little bit of John's bio. So John has always been driven by a desire to improve systems, businesses, and people perform. After earning a Bachelor's of Science in Technology from Pittsburgh State University, he began his career in commercial printing, helping multi-location retailers implement SaaS solutions and supporting telecom companies with data-driven marketing during early DSL rollouts in the mid 20s. In his mid 20s, excuse me. John joined a startup GIS firm and helped lead its national expansion, developing regulatory compliance services to the oil and gas industry. Over 14 years, he helped grow the company from a small startup into an industry leader. In 2016, John pivoted to real estate, earning his Florida real estate license and focusing on investing in capital formation. He raised private capital for redeveloped projects, completed dozens of exits, built a rental portfolio, and ultimately scaled into multifamily partnerships, representing more than $26 million in assets, 9 million in equity under management and growing. So without further ado, let me introduce you to my friend, John Funderburg. John, thank you very much for being here.
Thanks, Chris. I really appreciate it. Thanks very much for the great intro and especially for the disclaimer, because that is one of the things that I always struggle with is getting that disclaimer out. So let me quickly share my screen and see how this populates.
We can see.
Okay, perfect. So tonight I'm going to talk a little bit, quite a bit about the multifamily market cycle. And with everything in investing, the cycle of the asset is one of the most important of the asset class, is one of the most important things to kind of focus on and understand before you become a limited partner. So a lot of people will tell you it's always a good time to buy, and it is, but there are certain times that are better than others. And right now, in my opinion, and what all the data is telling us, multifamily is perfectly positioned for acquisitions and investments. So I kind of speak I'm a big movie buff. So I love movies. I talk through movies from time to time. So this is Jared Bennett in The Big Short when he was pitching shorting the housing market to a large hedge fund. And the thing that he was basically telling them is every single cycle has opportunity. So right now, the opportunity knocks with regards to housing, the opportunity knocks, and the opportunity is in multifamily. There's basically 4 market cycle quadrants. So there's expansion, there's hypersupply, there's increased vacancy expansion, and then there's a quadrant where there's declining vacancy and no new construction. So that's basically the 4 phases. It is long term. So multifamily, when you invest in multifamily, it's not a short-term thing. It's not a fix and flip. It's not a 1 year in and out. Typically, it's usually a 3 to 5 year hold. So you kind of have to look at where we're at and determine where the market is to decide whether you want to get in or not. But evaluating underwriting is always an important topic as well. So the burning question, are we at the top or near the bottom? Good news for everybody that's thinking about investing in multifamily. We are in the late contraction and early recovery phase, which is historically the best time to buy. Our last acquisition, which was in July of last year, we acquired a property for $9.7 million. It was 96 units in the University City quadrant of Charlotte. So on the north side of Charlotte around the university. Was not student housing or anything like that. But what we're seeing right now is there's a lot of financial distress. A lot of loans are coming due. So operators are essentially having to get out of their loans. That particular property that we acquired for $9.7 million had a $9.6 million loan on it. So where we were at with that property is we assumed the loan. So there was no new loan put in place. So we didn't have to pay absorbent loan fees to get a new loan in place. We were able to move quickly, basically bail the current operator out from the lender taking the property from them. So it was, like I said, it was about a 100-unit apartment. We got that particular property from around 79% occupancy in July of last year to we just reached around 95% occupancy. So we're in the process of refinancing out of that bridge loan that we assumed from that particular operator. So that just kind of goes to what some of the opportunities are that are out there right now. They're mainly revolving around financial stress on the marketplace. So it may scare some people, and it certainly has. There's a lot of LPs out there right now that are a little bummed about multifamily because of some non-performing assets. But when that's happening is really, it's kind of counterintuitive because a lot of investing is psychological, but it's really a good time to buy. When there's stress in the market, it's a good time to buy. So to really understand the cycle, we have to go back to basically 2020. These are the COVID years. So I call it multifamily cash flow fever. Everybody under the sun, any real estate investor or operator or flipper that was out there started looking at multifamily. I mean, the market was excessively hot. There was record low interest rates, massive liquidity injections into the market. So if you remember, the federal government was pumping market full of money. So we took all the interest rates down to basically zero and started doing QE, which is quantitative easing. There was also, for fuel on the fire, there was also historic rent growth, 15 to 25% in a lot of Sunbelt markets, but it wasn't uncommon to see even lower end properties raising rents 7 to 8%. Cap rates compress, and what cap rate is, it's a capitalization rate, essentially how we buy the properties, but it's important also to know that that goes into how we sell the properties and how we refinance them. So as cap rates go low, as in compress, the valuations of properties go up, especially on a commercial side, because everything is based on the financials on the commercial side. So cap rates compress to artificial lows. Aggressive bridge debt and floating rate exposure was put on the property. So people were putting higher interest bridge debt on properties in order to just close them, physically distressed properties in order to close the deal and get it. And they were paying super high prices because the market was really hot there as well. But that bridge debt is typically floating rate debt. So if you think about that from 3-4 years ago, all of that debt is now coming due. So we have some slides here in a bit that kind of explains that a little bit more. So basically FOMO took over. The fear of missing out took over. Rational underwriting completely left the building. So I've seen operators that have failing now that were underwriting 3.5% cap rates at exit, and we're typically running 5, maybe 6% cap rates there. And if you understand kind of how that works, is that essentially doubles the valuation of the overall property when you take a cap rate change that dramatically. Most cap rate changes are 0.25% to 0.5%, but we're talking about doubling of cap rates from then to now. So this guy, here's a few quotes of the time. So Jerome Powell is one of our favorite people in the world. He runs the Fed. He's the Fed chair until May of this year, which is an important point to bring up. He said, it's going to take some time before we see substantial further progress on the economy in March 17th of 2021. If we do see inflation moving up in ways that are persistent and significant, we will respond, but that's not our base case. If anybody remembers what happened to interest rates shortly after this, let's just say Mr. Powell was completely wrong. Janet Yellen, very famous lines. It may be that interest rates will have to rise somewhat to make sure that our economy doesn't overheat. Well, guess what? They pitched them from 0% to about 7% in a matter of about 6 months. So what that did, fast forward to 2022 and through 2024, that put a massive strain on the debt that was coming due in the multifamily market. Same thing in the office space, but the office space markets, commercial office space has its own issues with offsite work, remote work being very, very popular now. Office space has the similar issues, but way more vacancy in that space than that is here. So fast forward to 2022 through 2024, significant contraction, fastest rate hikes in 40 years. If you go back to the 80s, if any of us are old enough to remember the 80s or our parents talking about refinancing their houses, I remember my parents refinancing out of their 18% rate down to 12%. They were giddy. So when we look at our 6% rate, 5 to 6% rates right now, and complain about them being high, we really don't have a lot of room to complain about that. So we haven't seen super high interest rates, but compared to what they were in 2020, it's important to put it in context of what the market was doing in the early 2020s. So cap rate expansion, remember, as the cap rate expands or grows, the lower the valuation of the properties. NOI pressure for insurance, payroll, taxes. Taxes are a big one. We get hit with tax increases virtually every single time we purchase a property. We can do some things to mitigate it, but a lot of times it's very difficult to know what that tax bill is going to go to. And then the supply wave is the other large thing. So because of 2022, capital was so cheap, and there was a thing called 100% bonus depreciation put in play, all the developers started building Class A properties, Class A multifamily, virtually across the entire country. So the Sun Belt had the largest wave of new construction come online, and it started to go online in between 2022 and 24. So what that did was that put distress, financial distress, on the balance sheets and the income of every other property that was out there because there was this new supply. It's the old law of supply and demand. As you increase supply, if demand stays the same, then your price is going to go down. So we will talk about one kind of uncomfortable conversation here towards the end of the presentation. I have a little bit of an own thesis on kind of the supply and demand slide that may come up in the next couple of years. So the other thing is bridge debt maturities created distress. So obviously I touched on that before. As debt starts to mature, what happens is the majority of these loans are somewhere between 3 years and 10 years. Usually you don't hear about 10-year loans. But that's the window that they're normally in. So if you go from 2020 to 2022, that 3 years, it's ending in 2023 to 2026. So that loan is coming due. When that loan's coming due, you're talking about at least millions of dollars, if not tens or hundreds of millions of dollars on larger properties. If the other metrics like cap rates and your NOI don't hit, the problem is you can't refinance the property, so you're forced to sell. So fast forward to 2023, 2024, record deliveries. That's the supply coming online. So right now what's happened is basically new starts, they essentially collapsed. So when money got tight and interest rates grew, the cost of capital for new construction got so high that it just didn't make financial sense to build anymore. So all the building that's going on right now is essentially drying up the COVID money that was out there. So construction financing got really tight. So if you're going to do a development right now, you have to underwrite about 50% LTV on your construction costs. That around the COVID area was, you could get 100% in some cases. So money's really tight from lenders. Banks pulled back. And there, again, I talked a little bit about the downward rent rate pressure. That really started to rear its head in 2024 and kind of continued in 2025. We've seen a little bit of loosening of that right now. So after that, what's happening now? If anybody's ever watched Game of Thrones, every time they said winter is coming, something bad happened. And if you kind of look at this like you look at the 2007, 2008 financial crisis that came from housing, every time something bad happens, something good comes out of it. So the best time to buy a house, a single family house, if you had the capital, was 2009. I actually know a guy that bought a waterfront property, about a 4,000 square foot house in Gorda, Florida. Is one of my friends for $225,000 in 2009. Bought it straight cash. It was a short sale. And that house today is worth about 2.5 or $3 million, and he hasn't done a single thing to it. So that financial crisis spawned a extremely good buying opportunity. So the same thing is going on here right now with multifamily. This year alone, there's $1.2 trillion of multifamily debt coming due. That means opportunities. That means people are going to have to sell. That's continued forced liquidations. The biggest thing to know is the risk is in the equity. So if everybody's hearing this and they're thinking, man, this is going to be a massive financial crisis that's going to hit the United States, that's actually not the case, because a lot of the loans were lower LTVs, lower to mid LTVs, maybe 70%, maybe 80%. Yeah, the banks will have some exposure to them, but it's a relatively small market cap. You talk about housing, multifamily is a relatively small market cap. It's not near what single family housing is, but the big exposure here is the equity, which is where limited partners and investors come into play. So that is one thing to think about, is the equity really the risk play there. So cap rates have reset a little bit. We've got higher going in yields versus 2021 pricing, as in the prices are lower right now, roughly 30, 35, 40% lower than what they were in 2020 and 2021. There's less competition. I'll just tell you, our peers, there's a lot of syndicators that are not doing deals anymore. It's extremely difficult to raise capital. Part of it's that psychological factor of limited partners that have capital. They're in a couple of bad deals that are struggling right now. So they're really reluctant to put out more capital on another deal in the same asset class, where it's actually kind of counterintuitive to think if the prices are lower, that's really the best time to buy. Real estate, from a just general perspective, appreciates at 3% a year. Just over the course of time, 3% a year, you can almost count on that. But again, the cycles can really cause big swings in them. So negotiating power shifted. Buyers can basically demand concessions, credits, realistic underwriting, as in, when we say realistic underwriting, we mean non-compressed cap rates, so escalated cap rates at exit versus where we're buying it at, smooth rent escalation. So really, we don't go into a property, us as operators, when we underwrite a deal, we don't need $200 increases on properties in the first year. That's really unrealistic. Even $100 is unrealistic. We kind of count on the $25 to $50 increases every year, as long as it's proven out on the property. That's the way most people are underwriting, if they're not underwriting just flat for 1 year or so, just no income increases in the first year. It's a really conservative way to do it, but it's realistic. The more of these properties we take over, the more likely you're going to see, hey, we're not going to really improve this. It's too much of a shock to the residents that are there. And inflation has really cooled right now. So there's not a lot of increase in wages either. So it's not like you could just go to a tenant base and say, hey, give me $200 a month more. So it just doesn't happen. But last point here, basis matters. Buying 20 to 30% below peak pricing, it dramatically reduces the downside risk, because we're not counting on these massive inflations on the sales side. So on the back end, which is where most people, general partners and limited partners, most people, that's where you make the majority of your money on these investments, is on the back end. There is cash flow. So I'm assuming most people understand the 3 different lines of income that they get on these assets. So there's cash flow, there's profits from sale, And then there's the tax advantages of this. I'm not going to go much into the tax advantages, but I will talk about it a little bit. So some historical truth about cycles. This is where fortunes are built. You buy when there's fear in the market, holding through the recovery, selling into strength. So we want to sell when the interest rates are down, because when buyers are buying buildings, when they go get debt on the building, as the lower the debt, the more they can offer. So that's kind of the way to think about this entire cycle. So if you watch interest rates and watch where they're projected to go, it looks like we're going to be in a interest rate compression cycle for the next at least 8 to 12 months, something around there. The new Fed chair is coming in May or June. His name is most likely Kevin Warsh, and he is very dovish when it comes to interest rates. The best vintages historically occur in 1992 to 94, 2010 to 12, and 24 to 26, possibly. Those are, generally speaking, the newer properties are Class A properties. 92 to 94 is Class B range. There's still some properties out there. I have a thesis on where I think it's most advantageous to invest, but I'll show you that here in a few slides. So what are smart operators doing? They're focusing on strong submarkets, and they're using conservative leverage, 60 to 70% LTV. 75% is kind of pushing it, but we're seeing some properties that will pencil out to a 75% LTV on the senior debt, which is the mortgage. We typically stress test our DSCRs. So that's basically taking our income, moving it up and down to see if we're able to service the debt, even though we don't get the rent escalations that we think we're going to do, or our expenses go up. That stress tests our ability to pay the debt. And I talk to LPs, probably limited partners, probably every day. And they always ask me what the risk in these deals are. And really the risk is the operator being able to service the debt. So that's where the risk really comes into play. The only way you've lost money in these deals as a limited partner is if the property sells at a loss or the bank takes the property, which is obviously that's bedlam. You don't want that to happen. And that comes with DSCR. So you need to kind of ask those questions of operators when you go into a deal. And then smart operators also underwriting flat rent growth unless they have a really good reason not to. And there are some markets out there that some operators can have a really good reason underwrite some rent escalations. So risks, I do want to be clear. There is some continued short-term rent softness. So it's still very difficult to increase rents right now. So we were hitting 7 or 8% inflation in 2022. We haven't seen any deflation. Deflation actually is not good for the economy. That's essentially a 2007, 2008 financial crisis issue. And you hit deflation and people are losing their jobs. The stock market is completely tanked. Things are not going well. So we haven't hit that. I think that's partially because the Fed has kept interest rates as high as they have. So yeah, if they do go and just whack down interest rates terribly, that's a sign that there may be some things cracking in the economy. So the Fed has two mandates. One is jobs and the other is inflation. So if jobs are suffering, then they will start to move interest rates down. But there is still some expense volatility, typically in insurance and taxes. We're an operator that is partially vertically integrated. So we really control our contractors, our maintenance crews, the material acquisition of our properties. We control that ourselves. We don't outsource it. So we don't see any like escalated costs when it comes to that. But insurance taxes, we really can't control those. So those are typically what they are. And if you get into an urban area, taxes are just extremely difficult. We operate specifically in the Charlotte, North Carolina area. So we don't acquire properties outside of Charlotte. That's the only place that we purchase properties. And cover some of my team on the final slide. So there is slower lease up in oversupplied pockets, and oversupplied pockets again. That's more the urban areas where there's been a lot of build out in the last couple of years. We've seen an exorbitant amount of supply come online. It has really tapered off though. So also there is some recession risk out there, but long-term demand continues to remain intact. I do have a little bit of a different take on this, so I'll talk about that in my thesis going forward. So supply is shrinking. There's about half the startups that were happening as there was back 2-3 years ago. Distress is creating the opportunity, and inflation benefits smart assets over the course of time. So inflation is nothing but interest rates decreasing. So inflation is not something that we should really not be accustomed to by now. Anytime the Fed moves interest rates down, that essentially that devalues your dollar and creates inflation. So you have to have more dollars to buy the same goods. So the strategic window market psychology today, there's a lot of fear, fatigue, capital sitting on the sidelines. There's one of the things that you can invest in real estate with is a self-directed IRA, or a solo 401k. There is a ton of that capital just sitting on the sidelines waiting to be deployed somewhere. And really it's not being deployed right now simply because the market is so turbulent right now. So what typically happens next is stabilization. Early buyers are rewarded. So anybody that really has an asset that they bought this year, last year, even late into 2024 when the rates were still kind of high, in the next couple of years, if interest rates do start to push down, they are going to be the asset valuations are going to go up. Generally speaking, are most likely going to go up, I should say. I shouldn't say anything absolute because there are no absolutes in this business, but history tells us, and just general economic sense tells us, that as interest rates compress, valuations go up, and that's who's going to be rewarded. There is some cap rate compression happening right now, and rent growth we expect to return probably around the end of 2026, maybe into 2027. There is one caveat to that, and I'll talk about that here in a little bit. The opportunity, the problem with sitting on the sidelines is that window closes really fast, and you're not seeing any of this in the news because the news is really focused on single family. They're focused on what affects the kitchen table. So the people that are sitting at their kitchen tables and talking about stuff. So that's really what the news talks about. They don't talk about multifamily and where it is and the entire marketplace. It's very complex, but at the same time, that opportunity window is closing pretty quickly. If you do start to see interest rates go down, what you'll see is prices on these buildings go up. And right now, like I said, we're buying about 30% below basis. Legislation changes that affect tax incentives, that can also change the strategic window significantly. I talked a little bit about 100% bonus depreciation. That's in place again. That's because of the big, beautiful bill. One of the things that multifamily investing and real estate investing in general gives you is essentially, and it's not absolute, but essentially it gives you tax-free cash flow. So if you get a 5%, 7% dividend on a building every year, in addition to what you think you're going to get in the upside, that 5 to 7%, if you invest $100,000, that $5,000 gets offset by the depreciation. And you can continue to push that forward throughout the life cycle of the entire investment, and then take it against whatever benefits you get on the back end. So on the sale. So that will not change. That 100% bonus depreciation is essentially in place until the tax law changes. So until Congress does a revision to the tax law, that is going to stay in place. So I think we have 2, maybe 3 years of 100% bonus appreciation that's probably going to be in place, but it is something, it is one of those big incentives. I personally, that's my favorite part of investing in real estate is the tax benefits. So why it matters? It matters for LPs. It's a better entry basis. So if I told you you could buy if a stock was that if its value was at $100 and it's being sold for $60, of course everybody's going to say I'll buy that. The same thing that's happening in multifamily right now. The entry basis is so low, the opportunities are good, but they won't last for long. So more conservative underwriting. That's one of the things that LPs really need to dig into and understand from the operator themselves. What supports their underwriting? What market metrics are out there? What is the appraisal? How many opinions have they gotten on their cap rates? Are they underwriting large rent escalations? If so, why? What type of accounting are they doing? Those are all questions that you really have to ask operators before you decide to invest in their deal. The reduced downside risk versus 2021 is huge. Most of some properties, we invest in properties that are cash flowing immediately. Um, and if that is working out, you don't have any type of risk on the debt being serviced. So compared to 2021, the downside risk is minimal right now. So there's a potential for a strong 5 to 7 year vintage. And then this really is a vintage year opportunity. I mean, it is a generational wealth building opportunity. So my thesis on supply and demand, I will say, I kind of have a little bit of a pessimistic opinion of what's going on with supply and demand. That's counter what is out there. Anytime you turn on the news, you immediately hear housing. Anytime they talk about housing, you talk about housing crisis. We need more. We need more. We need more. Well, there's a couple of things that are kind of dampening that stat, if you ask me, in my opinion. So the big one is immigration control. So obviously, I'm not speaking about political sides or anything like that, but obviously, this administration has a different stance on immigration than the previous administration had, and the demand for housing is really counter with that specific stance. So one was bringing in mass immigration, the other is exporting immigration. So those are two counter to thought processes when it comes to supply. So it's an uncomfortable conversation. So I believe that there's some downward demand factors coming into play. Immigration control. If you look at our birth rates are under 2.0 for the first time in about 50, actually more than 50 years. Actually, it's the first time ever almost for the United States to have birth rates under 2.0, which is below replacement level. And then this is the real uncomfortable thing, the boomers life cycle. So if you haven't looked at boomers, there's roughly 20 to 30 million boomers. That's the expectation of boomers passing in the next 5 to 10 years. So a large part of their assets that they have, their single family houses. Boomers are the largest population that owns single family houses. They're not moving. They're still living in their 2,000 square foot, 4 bed, 3 bath homes, even though their kids have moved out and they're not selling. What would they sell? What would they go buy? They would go buy a very inflated house compared to what they bought that house at. So those are three things that in my opinion, will factor into uh, the demand factors when it comes to multifamily and housing in general. So there's probably going to be a normal or a small increasing of supply, and I think that increasing of supply is going to come from mostly in the single family market. Again, with the life cycle issues, so new starts are down. They are down from the peak, but they are gonna pick back up as interest rates compress. And then that generational supply influx, it looks like we'll probably start triggering in 5 to 10 years, somewhere around there. So what does that mean? There's a huge opportunity right now in the tertiary markets. So in the urban areas where taxes are high, population is dense, construction is expensive, land is expensive, insurance is expensive. Most people are moving into urban markets. Um, there's not much industrial development in urban markets. The majority of, if you look at the industrial development that's happening, it's been happening mainly in the rural areas. It's happening on the outskirts of urban markets and or in the rural areas, because land is cheaper. It doesn't cost as much to develop there. And they don't have to deal with a lot of the regulations that are going on. The other reason that tertiary markets, I think, are going to be a real opportunity is there's limited new construction. So there's not a lot of development of multifamily in those areas, but they still have to have housing. It's a stable, it's a stable, not necessarily a fast growing population, but a stable population. Higher construction costs relative to achievable rents. It's a smaller development pool. Very few developers want to go into tertiary markets, but and there's less institutional competition. So large hedge funds don't want to put money out in those areas. It's historically been considered a risky asset. So the result is structural supply constraints. So we don't see this, if we don't see the supply there and the demand even stays the same as inflation starts to come in, as interest rates compress, income will continue to increase. It'll be easier to make those rent increases there, and the lack of supply makes it a perfect opportunity. So, and in a lot of the tertiary markets, it simply doesn't pencil to build new Class A product at workforce rent levels. So the majority of the population there's workforce housing, workforce people, and you're not going to see somebody go in there and build a lifestyle property, a property with a bunch of lap pools and massive gym equipment and that type of stuff, come in there and outperform a B or a C class property. So why it makes sense? There's essential workers, there's a local service economy, lower rent to income ratios, and sticky tenancy. These people, generally speaking, don't move. So you don't have to demand a lot out of them, and you don't have the supply that's going to like push them out of that particular building. So it's a necessity product. Again, like I said, it's not a lifestyle product. So there's not a lot of, if you go buy a building in kind of a tertiary market, you don't have to do a ton. You have to get that $25 to $50 annual rent escalation and make large NOI. That makes massive NOI impact with net operating income impact, and generally increases the valuation of a property. So in closing, the cycle's not broken. It's consistent with what has been done in real estate the last 50 years. It just continues to go in cycles. Interest rates go up, they go down. We just had a black swan event, and we're feeling with COVID, and we're feeling the effects of that black swan event right now. And the opportunity is there for us to kind of capitalize on it. So it's functioning exactly as cycles always do. The question isn't, is the market perfect? The question is, where are we in the cycle? And historically, buying during contraction has produced the strongest long-term results. So when we say long-term, we mean typically like 3 to 5 years. So to get a hold of me, my website's at the bottom. You can scan the QR code there, book some time to talk with me. I'm happy to just have a conversation about markets, generally speaking, what your goals are, what investment works for you, what doesn't. I will say this, I take more of a consultative approach. Real estate and passive investing really isn't for every single investor that's out there. So any operator that you're talking to should really assess where you're at with your with your portfolio, with your finances, and determine whether real estate is really a good fit for you. So if you think it's something that you want to be interested in, book a call. We'll have a 30-minute conversation and see if it's a good fit. My team. So I'll talk a little bit about my team. I'm with a general partner group. Myself, I'm with Rampant Lion Capital. I'm the founder. Ryan Carter runs Vertex Investments. He's our boots on the ground guy. He's a general contractor. He runs all of our maintenance crews. Um, he runs all of our construction crews. He's in Charlotte, and I can't stress how important that is. If you're evaluating operators and it's a an operator that I'll say this, every acquisition that we've done in the last 3 years has been from an operator that's out of state that bought a property from halfway across the country. They're just relying on property managers to manage the property, and they don't even have boots on the ground there from a general partner perspective. I can't stress how important that is. That's why we focus on Charlotte. We've got our operations there. Ryan is there. Sandy Bondurant's also one of my partners. She's a Charlotte native. Ryan is a Charlotte native as well. And then Jordan McNeely, with Grace Investments, is our analytics guy. He does our underwriting and a lot of our KPI tracking and stuff like that. So with that, Chris, that's all I have for everybody tonight. I'm happy to have conversations, entertain any questions, and just dive deep further into really any topic on multifamily if
I
anybody
think
wants to.
that's exactly it, John. John, that was fantastic, man, and I really appreciate you sharing a lot of gems tonight. I think it would be great if anyone has any questions, please feel free to come off of mute and ask them, or if you prefer, you can type them into the chat and I can read them out, and John can address them on the spot. And while people are maybe formulating their question, I was thinking, John, I think your thesis is pretty spot on. I would add to that, that I think the most significant part of it from my point of view is on the baby boomer implications with respect to them not selling their homes that they've lived in. They're sitting on a ton of equity. They might want to sell to be able to get that liquidity, or and so that they don't have to do a HELOC or take a home equity loan or something along those lines. They'd rather sell it and downsize and go live somewhere and down in your way in Naples or Fort Myers or Miami or something like that over here on the East Coast. Or, I know the pattern out West is, the Minnesotans would go head down to Arizona and all that stuff in Nevada. But I think about the impact of all of us, myself included, during the pandemic, refinancing from what was a pretty decent rate. I think I was in like the fours or fives to like a 2.5. And I'm like, why would I sell? It's like free money. And so they've done this too. And then there's not a whole lot of new construction out there in the single family market. And the idea from a real estate perspective of people have to live somewhere. And so that I love the sweet spot that you guys look to focus in those tertiary markets, where it makes sense, where there's not a whole lot of supply there. I think that really is a solid thesis. And finding those deals is got to be hard work but having boots on the ground to be able to do that is really, really smart.
Yeah, it's extremely hard work to find the deals, dude. I mean, we work, as well as I do, we work about 6 months on a deal before we close it. From the time that we underwrite it to the time that we submit the LOI, wait, do the best and final, to the time that we go under contract and do all, and then raise the capital for the deals, which in my opinion is the hardest part. It's trying to convince people to give us money, and talk about how we've conservatively underwritten the projects. And with all the moving parts in these deals, it's very difficult to articulate that in a short amount of time with somebody who hasn't looked at it. But those kind of outskirt markets, I really think so. What we look for is path of improvement. So we look for areas that are being or have some industrial development that's going on that's going to support wage growth. And then we'll go buy a class B or class C property in the area. We like class C's because we really don't we don't, like I said in the presentation, we don't go in and just blow these. And there's a human element to this as well. And I know back in 2020, 2021, people were bragging about, oh, I raised the rents $150 a month on this thing. Well, that's not good. That's not the best thing to do all the time. So, and the market
Right.
won't allow that now. If there's an operator underwriting that right now, the
Right.
LP should just say, you know what? I don't think you're gonna hit that on a year, and your money's at risk. So
Yeah.
typically what it does is they've overpaid. So it makes them overpay for the project. And then, and like I said, we're the opportunity is to buy not necessarily older buildings. I'm not talking 40s, 50s buildings, but you get a building in the 70s, there can be some physical things that you have to do, but you can also get good deals from buildings that are built in the 90s. That's the one that we acquired in July that we're in the middle of a refinance on. And that property is, it's a gem.
Yeah.
The deal it's a smoking deal. So it's probably the best deal that we've done yet. We actually sold our equity on that project. We have a lot of capital partners that come in on the projects.
Right.
Um, we sold our equity on them. We sold $2.8 million in about 30 days.
Way to go.
Yeah. And I mean, it was filled, and we're a little behind on our refinance. We thought we were going to be able to get it done in Q1, but we're a little behind on it. So we just hit our metrics, and we'll get it done. We'll get it
Who knows? That
done there.
could be favorable if if rates drop and then the get tap into that a little bit more. But here's we'll see. And Matt, I see you have your hand up.
Yeah, hi, John. Great presentation there, John. I
Thanks,
had a
Matt.
question on, I know you're talking about like struggling operators, and you spoke to some of your deals that you've gotten from struggling operators. And I've heard of some that are doing capital calls as well. On your guys' specific deals, how are your guys' deals performing? Are you guys struggling at all? Are you guys paying distributions or holding? How's that looking for you guys?
So we have a bit of a mixed bag. So we have one property that's struggling on the. I will say this about our entire portfolio: none of our portfolio is at risk of not making debt servicing. So our current operations is supporting all the debt servicing and our accounts payable. So we don't have any risk when it comes to that. We are making distributions. And that's kind of uncommon in the industry right now. There's a lot of I know of a very large operator that's got about $300 million out of in assets under management that didn't make a single distribution last year. So we're making distributions. We did have to pause them for about 6 months on a couple of our properties, just due to some of the things that we were seeing in the market and how it was going. But we have started those back up. We had a fire at one of our properties, which caused some significant issues, obviously. But we've since recovered from that, and we're started back up distributions in January of this year. Typically on the property that we acquired in July, typically we don't do distributions until we refinance, because we know that we're going to have a lot of fees that come up. We don't want any of that cash going out of the business. So the thing that operators really have to, and this is kind of, a lot of people spend a lot of time on the income statement. So when you're looking at financial reports, you're looking at income statements, people don't spend very much time on the balance sheet. And that's really what you need to focus on, because that's the health and the lifeblood of the business. So as a former executive, I've spent ton of time on balance sheets. And that's really where I live. I won't do a district. I'd rather not send money out. And then I'd rather not spend $300 out to somebody a month and then ask them for $30,000 the next month. That's a bad deal. That's not paying attention to your balance sheet. So we're at the place where on most of our portfolio that we can make distributions. We've got enough health on our balance sheet, and our income is there that we can make distributions, unless we're in that refinance cycle, which we're in on one. But great question, Matt. I mean, the one thing that operators really struggle with, some operators really struggle with telling investors some bad news. And that's, you want to deal with somebody that's transparent in what they're doing. You want to see those financials. You want to look at them. You want to have access to the operator. So that's one of the things that's very important. And a lot of operators don't want to have those bad conversations. You kind of have to force them to. It's your money that's at risk.
Yep. Great point. Great question. Well, John, what I'm going to do here, there's one more question that I'll help us bring this to a close. So how do you find value add multifamily properties in current markets?
So great question. So because we're focused in one market, we don't have deals in other markets. So we have excellent relationship with brokers in the area. We network a ton in the area with brokers. Ryan Carter that I mentioned, that's in the area, he's also a broker. So he has access to all of that information, and he holds those relationships. So that is the best way to in our opinion, to get access to those deals. There's some websites that you can go to, but the old saying in real estate is, the online is the place where deals go to die. So you could go look online. There's a couple of websites, Crexy and LoopNet is one. But broker relationships are the best. You could also source direct. So I think that there's going to be a ton of opportunity from direct sellers, especially if you're focused in a market. Direct to seller can be a very good thing. And that's done with just good old guerrilla marketing, direct mail, bandit signs, stuff like that. Hey, I buy apartment complexes. I buy small apartment complexes. If you put that on a bandit sign, you're going to get some phone calls. I guarantee you're going to get some phone calls. So those are other ways to find deals.
Great stuff. Great question. John, I'm going to help us wrap up here with some questions that I ask all of our guests, expert guests on, to talk a little bit, but just so we got to know you and your expertise from a real estate perspective, but let's get to know you a little bit more personally for those people who are out there who are live, and then for those who will watch it on the recording. So my first question for you, I'm a big traveler. I just actually got back from Naples, Florida with the family, where my kids were on school break, and it was absolutely 80 degrees and sunny every day. And then I came back to the Northeast to a blizzard with 2 feet of snow. So what I want to ask you is, what is one of the best trips you've ever taken and why?
Best trip I ever took was actually a trip with my best friend, his wife and my wife down in Cabo San Lucas. We spent a week there on my 40th birthday. So I can't spend time with anybody other than my wife and have a better time. So
Awesome.
That was the best trip I've ever taken.
Awesome. Yeah. Beautiful area there in Mexico, and, lots of sun and sand. I'm a sun and sand guy all day. So thanks for sharing that. Tell me about this one. You talked about your partners and your focus on the Charlotte market, and tertiary markets there, but what are some of the things what is one thing I would say that you're working on these days that really excites you?
So we're working on, so number one, expansion. That excites us. We're acquiring as much as we possibly can. We're limited by the capital that we have, obviously. But the other is fully vertically integrating. So I mentioned that I talked a little bit about our construction crews, maintenance crews. The next thing on tap for us, even though we're fairly small right now, is possibly acquiring a property management company or starting a property management company and bringing that in-house ourselves. We are of the opinion that nobody is going to work the properties better than the owner. And property managers, I have respect for them, but it's really, it's very difficult to work with property managers on properties. You're very limited in the pool that you're going to pull from and the talent with property management. So nobody's going to work it better than the owner. And that's probably next on the horizon for us as far as expanding our operations in the area.
Great stuff. Super excited. I'm looking forward to seeing that come to fruition. Next, there's only two more questions left. The next question is, is financial freedom. What does financial freedom mean to you?
Financial freedom to me means the ability to spend more time with the people that I love. That's what it means to me. Um, I'm kind of opposite. I traveled a lot in my former career, so I'm not a big traveler. But spending time with my family, my kids, seeing my kids grow up and leaving a legacy to my children and my hopefully one of these days my grandchildren. That's really important to me. So I think that multifamily fits into my portfolio of how to do that. There's some other assets that I invest in and I run that I think are the future for investing and for the next generation that's coming out. But that's leaving a legacy to my kids and grandkids. That's what it means to me.
That's awesome. That's awesome. And then finally, the namesake of this meetup is wealth mindset. And, I tell a brief story about, wealth mindset means different things to everyone. It's not about the money in many instances, but, what I'd like to ask you is, what does having a wealth mindset mean to you?
It means to me, it means the ability, frankly, to just have conversations about this topic, which a lot of people don't. A lot of people just can't have conversations. They can't fathom what's out there in the world and what things mean. It means the ability to change people's lives with just a nugget of information. Hey, interest rates are getting ready to decrease. Do you know what that means? It means maybe an opportunity to buy a house. So having the ability to change people's minds, change people's lives just with information, that's what it means to me. But it also, it's a different lifestyle. I'm as humble as a person can be. I drive a beat up, Ram 1500. I never want to, it's really not about the money. Money, I know a hedge fund manager that says money's boring. The guy's filthy rich. And it's like money's boring. So it's really not about the money. It's just about having the confidence and having the ability to have conversations with people about this stuff and aspire people to do different things with their lives. I was in a job that I literally worked 20 hours a day. I was an executive, in a massively growing company. We went from $1 million a year to $35 million a year in about 9 years. And I was a big part of that company. And I didn't have a life. That's completely my mindset has completely changed from being entrepreneurial and just having a life, being able to sit with my kids and have a conversation. So about real things, that's kind of what it means to me.
Oh, that's awesome, John. I'm so glad that you shared that. And I'm so glad that you were able to take out some time to share some great perspective with us tonight. One last time, tell people how they can get in contact with you before we wrap up.
You can find me on LinkedIn. I'm not the only John Funderburg on LinkedIn, but I'm the only John Funderburg that looks like this. So there's not very many John Funderburgs out there. Is a couple, but You can find that's the best place to get a hold of me. My website's at rampantlioncapital.com. You can contact me through a contact form there, or my phone number is on my website as well. People call me, text me, I will respond. So that's that. It may take me a day, but I absolutely will respond. Trust me on that.
John, thank you so much for your time. Thank you, everyone, for joining this evening. Have a great night, and stay tuned for the recording that will be posted on our YouTube channel and sent to you all via email. Have a great night. Bye bye.
Thanks for coming, everybody.